Crisis in Italy dominates markets. The government having to pay up to borrow money. 10-year yields soaring to a euro record high as Prime Minister Berlusconi fights to stay in power. And Greece scrambles to put together a new government. Prime Minister George Papandreou is out, and the heat is on to pass more austerity measures in exchange for more bailout money. Euro just dominating trading. U.S. futures headed slightly lower. I'm Alix, and the morning call starts right now.
Good morning. Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Alix with The Street, and together we bring you a morning call. Happy Monday, everybody. It's going to be crazy, so let's get to it. So S&P having its first down week last week in 5 weeks, and we're seeing futures very volatile today. What's the line in the sand? What are you looking for technically with the S&P?
Well, I'm going to give you guys two levels to trade against, because last week we held the 38.2% retracement, which stood around 12.15. I know we got hit hard with 2 distribution days early in the week, which you never want to see. But you know what? We had a huge rally off those lows. But then later in the week, we kind of regrouped. Stocks acted well. So you still have to have a bit of a neutral to bullish bias versus neutral to bearish bias, just the way stocks are acting. But you can't be all in right now.
Well, I was reading a note from Bespoke over the weekend that said from 2000 to 2010, the S&P averaged almost 1% between the 1st of November and Thanksgiving, and then 1% from Thanksgiving to December. So I have to wonder if we might see a little bit more juice, but if we're just going to kind of peter out.
Yeah, well, after having a 15 to 17% move off the lows, and maybe there's room for a move to 1320 to 1340 if the environment is perfect. There's not a lot of opportunity. That's why you need to be very selective, especially when you see all these headlines, and these headlines are hard to deal with. They're very, very complicated. There's systemic risks, systemic situations just unfolding daily, weekly in Europe, and you have to kind of know what they mean, but more importantly, how the markets react to it.
All right, so let's take a look at the chart, because I was reading a note from Waverly that said they're recommending traders kind of get 25% long of their whole portfolio position, but stay pretty nimble. So let's look at the chart and see what you would do.
Okay, let's take a look at the S&P right here. This is the chart. This is that Tuesday, that October 4th low, the outside day where the rally went on. This is when we broke this descending channel. This was that peak, but look where we peaked out at 1292 into old resistance, and then we had that pullback, which was about the 38.2% retracement, showing some commitment, bounced back up. But we're in this somewhat macro or wedge type formation. It's like a new formation that's here, and the market's not sure whether it wants to continue to the upside or resolve to the downside for more corrective action. So watch this 1235. This was that Thursday, Friday support, but then really big support would be at this 1215. So if we start getting below 1235, I'd be a little alarmed. There may be lighten up some risk, but if we close below 1215, I think we're back to a neutral to bearish versus neutral to bullish.
Fair enough. So let's go to the sectors that you might actually want to be more neutral to bullish in for the longer term. I want to go to tech. Been holding up really well, and it's a seasonally strong buying period. Do they have more juice? Do the Qs have juice?
It's in the same type of pattern, stalled in front of the highs. This has been a leading sector. It's something I'm going to watch today and this week. If you take a quick look at the Qs, you will see that this had a big move off the lows, didn't break the lows, showed relative strength, and then broke back almost to the highs, almost back to those July highs, and now here, another wedge type formation. The Qs start getting above this 58, perhaps we see some upside momentum. If it starts getting below this 57, you'll know that you should have some upper level stops, because the next area below could be around 55. So if you're not committed to this trade for more than a week to a few months, just watch this wedge and see which way it resolves.
And then would you be taking those trades on right now, or you really have to wait for some direction?
Well, right now I'm long about 4 or 5 stocks, and I'm short the spiders. I think if anyone's going to be long, you have to have some hedges. Out of my longs, 2 of them are actually in tech. I'm long Apple, I'm long Google. And then I'll get to some others as we move along.
Ooh, good hint there. All right, I also want to go to retail, because it's been holding up really well, and I'm going to give you more statistics because I think that they're fun. So Bespoke said that retail between November 1st and Thanksgiving has returned about 1.6% from over the past 10 years, but only 0.6% from Thanksgiving to Christmas. So I kind of wonder if it could rally for a few more weeks and then also really stall out here.
So that's why at the upper level, when there's not a lot of room, you have to be very careful. Maybe be in a tier 1 and only get to tier 2 or 3 if you see that great setup. Retail looks like tech. Retail rallied well off the lows. Look how retail held up here. It didn't go back to those lows of August when that October 4th came in. Went back almost to the highs. Look how close it got. And now it's wedging as well. If these RTHs start to get above 111, you could see some more energy in retail. We've been having good action in Under Armour, Lulu, Deckers. There are some stocks at historic highs, so they're rewarding investors and traders, but you have to make sure you're in the stock showing relative strength, and there's been relative strength in retail and in tech.
And oil as well, there have been some stocks showing a lot of strength here, and oil itself has been holding up over $94, which is really impressive considering all those volatile headlines coming out of Europe.
And you're starting to see some strength in the refiners and in that group as well. And that group wasn't showing relative strength, but it had an enormous move off the lows. So if you're a trader and you're a market timer, you didn't have to just be in the best acting group. You could have timed it off the low. And if you look at the OAHs here, let me give you some little color here. This was that reversal. We came back into resistance, and now we're wedging here. The question is, if we can start getting above this 130, 134, there's like a void back up to 150. And last week we saw a stock in this group that actually powered through that resistance, which a lot of stocks haven't yet. Look at EOG. It actually showed you that something could power through, because same type of setup as the OAHs, moved back into resistance, was wedging, and then blasted through resistance. So maybe a stock like APA could do it, right? Wedging right here at resistance. If it gets above 105 or so, it can continue. And then you have some others as well. So you have to look at the setups that are setting up versus ones that actually followed through.
And EOG is interesting because it really rallied off the CEO after the quarter saying, you know what, natural gas isn't really going to do anything here. We have to diversify more into oil, so go figure.
Yes, they try and make as many people feel as stupid as possible in this market.
So another downside for natural gas on that one. Okay, I want to go to financials. Seem to really be unable to recover after Monday from last week, but I was reading a note from Canaccord over the weekend who basically upgraded U.S. financials from underweight to neutral, saying that all the bad news is baked in and we'd have to have, you know, some catastrophic event for them to really go lower here. Do you agree?
Well, like a hard default in Greece or 10-year bonds in Italy soaring through the roof?
I think that the note would argue that that's already baked in at this point.
Okay, so that's why you went so confident to neutral?
Yeah. From
okay.
underweight. Maybe that's
there you go. Anyway, XLF, you take a look here. You know, it had a nice move. XLF, we played along in this rally also. This is your reversal day. This is when it broke this mini downtrend. And a nice move up to resistance. And I would say at this point, it's wedging again. You see a wedge in a lot of these stocks or a lot of these sectors because market's in a pattern of indecision right now because you've had a big move. The question is, can it resolve and continue, or was it too much or too fast? So I would say on the XLF, watch this 1280 area. It should not get below this 1280 to 13. This is your line in the sand here. If we get it close below this area, it's going to be like a resolution to the downside. If you want to watch a stock with it, watch Goldman. Goldman's been trying to put in some kind of support here around this 100 to 103. If Goldman breaks this mini uptrend that it's been following, you're going to see a psychological shift in the banks, and people are going to start getting fearful again.
And really quick, want to wrap up with industrials. They fell about 1.4% last week. Wasn't terrible by the other sectors at all. Do you see more upside here?
Let's take a quick look.
Or are we going to say wedge? I think he's going to say wedge.
Mark Haynes, who I love to fight with and had a good time with, he said, first time I was on CNBC, he said, is this wedge going to give me a wedgie?
Yeah,
anyway,
I'm not going to say that, but let's go to the chart.
Here you go. At 34, above that, it resolves to the upside. Here's your big support around 32, 32.50. So, you know, same type of pattern, same type of concept.
All right, and we will be right back with IPOs and how to trade the names like Groupon and more tech names right after this.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, let's get in the trenches here. We're going to start with Groupon. So rallied as much as 50% on Friday, but closed up only 31%. Two questions. Was it positive that it rallied so much on a down day, or was it negative that it really couldn't hold those early morning gains?
I just think it was almost a non-event. They got the
they
got the IPO out. I was ready. My whole trading floor was ready to go with the first day of trading rules. It opened up around 29, went to like 27, and then once it went above 29, we bought it. Had a quick move to 31, and then once it went back below 29, it lost its momentum, it's lost its gas, it closed near the lows, and now it's in a void. I'm sorry, it was not a very good trading IPO. If you got stock in the deal, congratulations. You know somebody. I don't know someone over there, so I didn't get any, so it did nothing for me.
Also, because I was wondering how much of the juice kind of was because lack of supply. I mean, I think that we're only looking at 5% of its shares on the market versus the average for tech, which is 20%. That's a big difference.
Well, that's why we were somewhat excited, because it was a small flow. We figured that if people wanted to own it, and they think it could be like a Google where it hovered at 99 before going to 700, that there would be demand, but there wasn't even demand for that small little float, because LinkedIn had a small float, and it was much better 2-day action versus Groupon.
Right, right. All right, so then you want to avoid it as a trader, and then for the retail investor, you have to avoid an IPO right when they come out, right? It takes about 3 months to settle out.
Yes, it takes about 3 months for institutionals to get in there and support it, 3 months or so to get the levels to trade against, and that's why let's turn to LinkedIn since I just mentioned it.
Since you mentioned it, perfect side. What am I saying?
Segue.
Segue. Thank you. It seems trapped now, I have to say. I mean, we saw revenue popped in the third quarter, guided higher, but earnings were still disappointing, and the stock fell on that. Isn't that pretty disappointing news?
It was disappointing,
Yeah.
and the earnings weren't blockbuster. It was almost a bit of a reality check. Stock was down like 7 or 8 pre-market and closed off its low, so it's still in that zone. It's still in this type of pattern. If you looked at LinkedIn, all it means is it's not going to be going anywhere soon. Okay?
But I mean, it did report higher revenue and guidance, so isn't it even more of a negative that it went down on that news?
Yeah, I guess so.
Right.
You know,
Sorry,
if you look here, just from June, how many months? June, July, about 6 months.
Yeah.
You would think that there's enough of a base here to trade against. Every time it's looked like it was going to break out, it failed. Looked like it was going to go here, failed. Just had a nice constructive pattern right here where I was watching to see if it would trade above 95. It did not. So it's still in this zone. I would say if you want to be in a tier 1, have a stop at 70, because if it breaks below 70, it's going to go back to those lows. But if you're looking for momentum, there's going to be none here until it starts getting above 95, and I don't see it happening anytime soon.
And Dunkin' Donuts as an IPO has also been really struggling, right? I mean, it's like $1 away from its low.
It looked good. I talked about it, and then they came out with that secondary
Right.
that diluted it, and all of a sudden was off my radar. If you look at DNKN, you will see that it's just nothing. Okay, it came back up to resistance, and it was looking like it was going to get some momentum, and then they had that announcement. It broke this uptrend that I was tracking from early September. Here was your way out around 28, and now the only thing you could do is maybe if it gets back down to 25, you can nibble a little bit, but I don't think you need to be in any rush. This is a little bit disappointing also.
2 IPOs I just want to hit on really quickly is Zillow, online real estate information hub, if you will. It was up 8% on Friday. It was pretty positive. Would you be trading that?
I've looked at it.
Yeah.
This pattern actually looks decent. I'm not sure when their earnings are coming in, but if you look here, same type of thing. Big first day. Actually, this was a horrible first day. Closing the lows.
Last week actually guided higher for the year revenue. So
okay. And it reacted a little bit to it. So if you looked right here above 29.50, maybe it has some room back, but nothing great here. A real estate website, whatnot. It just doesn't do anything.
They booked like a lot of subscribers in their last quarter. So I'm just saying.
Okay, good.
All right.
Could be good.
GM. I know people don't think of it as an IPO, but it is an IPO. We saw some positive comp data come out for auto sales. China jumped 10% in October. We also overall just up 2%. Are you trading GM?
Nope. I think maybe once a year we look at it if there's a compelling area, almost like Ford. This also, look at it since it went up, had the IPO way back when. Another, it's a disappointment. Look at this. Look where it is now. These are 5 IPOs I just showed you. Usually you're supposed to find the best gainers after the first few years of an IPO, and none of these have rewarded any investors that got involved after instead of before. Maybe that's why some of these Occupy Wall Street guys are ranting and raving.
Yeah, I don't know if they're too concerned about IPOs. But
that's why I'm ranting and raving.
But before we go on to quick hits, I just want to ask if this is sort of a negative for the market that IPOs are doing so poorly.
I think it just shows you that the risk is off. People say, oh, the risk on trade's on, the risk off. If risk was really on, you would see some of these new issues, which are supposed to be the newest, the most innovative, the tightest floats, stocks that institutions want to see go in their first 1 to 3 years. But I guess it's only like 6 months or so, so there's time. You would see them acting better. It's hard to have the names we know act well right now, let alone these IPOs that are still somewhat unproven.
Right.
They need to have more quarters worth of earnings in order to get some support and get some confidence.
Talking about some names that might not be acting too well, I want to hit on Apple, around 400. What are you doing?
Apple is going to be my proxy for the week. It's in a box. I said on Friday, I'm like, nobody puts Apple in a corner. Well, they put it in a box. And Apple right now, if you take a quick look at this pattern, I think this is going to be an interesting proxy for the market. It's still being controlled by this island top. If Apple starts to get, first short term, I would say, is above 403. That's its first objective. But really, if it closes above 409, 410, that will be very positive for the tech sector. But if it starts to break and close below this 393, it could see the 200 down on 360, and that's going to be a blow to confidence overall.
And will Google also be a proxy, kind of almost at that $600 level?
It's the exact same scenario. It had its earnings. It's in a box. I'm not going to show you the chart. If it gets above 600 and stays above it, you could see highs. If it starts getting below 580, it's going to get into that gap, and you're going to see a negative psychological effect. So Google and Apple will be some things that I know traders will be focusing on, and I'm in both, and I'm going to try and stay in ed. If if it works out, but I'm not going to be stubborn. If we hit those levels of weakness, I'm going to get out and I might even flip short.
Wow, okay. So what about Green Mountain Coffee, though? It seems to want to mount a little rally here.
You know, this is different. This is a former
Definitely
leader
trading vehicle,
that
right?
lost its momentum. It's been a good trade from the lows. If you take a quick look here, you will see, I know Mark's been trading this a lot. You know, this was the somewhat of a bottom. It just broke above this mini downtrend. I think it's got room back to 75 or so. But you're going to have a lot of resistance once it starts hitting these 80s. So there's a little room to play. I'm not going to be involved there.
And Caterpillar, waking up.
Yes, Caterpillar, for all the institutional investors out there and people who love to own it, still hanging around, still looks good. I think you could stay with it a little bit more time. Might even break above 95 for a trade.
And then just because I cover gold and I want to go to Rand Gold. The Q3 print was pretty disappointing, but the stock rallied anyway, which I think was really telling. It's like $1 away from 52-week highs. You don't want to chase here. But if you want to get involved in the name, what's a good strategy?
Well, weren't you telling me to buy this below 75?
At 72, I was still loving this stock. That's all I'm saying. I'm not a stock picker, but that's all I got to say about that.
Well, on earnings, we talked about the line in the sand, 115. So if you look at gold, this was just really good for confidence for the miners, okay, of stocks that actually could break out and not fail like they typically do. So
That don't have to bribe with high dividends, I just should say. But go ahead.
well, we talked about 115.
Right.
It flirted with it that day, and now it's holding well above it. I don't think you chase it and buy it up here, but if you're an investor, you're rewarded and you should stay with it. You know, and it still acts well, and stocks in this group are acting well. The miners are actually getting some respect, even though Barron's did a negative article on them, but they liked RIM around 28.
There you go. That
There
says
you
it
go.
all.
It's at 18.
All right, so we're wrapping it up here. Scott, I just got to say, as a trader, what's sort of the one thing you're going to key in on this week? Is it going to be a headline out of Europe?
Well, it's going to be the headlines out of Europe. It's going to be the two levels in the S&P that I'm watching, that 1235 and 1215. It's also going to be what happens with Apple and Google. Do they break above these ranges or below it? So they can give us some clues which way we resolve, if we go back to the downside or if we hold in steady and have a little bit more price appreciation going into the end of the fourth quarter. But you have to have a hedge on. Okay, like I felt much better this morning when I knew I had some spiders short alongside my 4 or 5 longs, because I knew that's how you can manage the positions. You just can't be all one-sided. You can't even be all short right now, because even they're getting screwed. You have to be mixed.
Caution.
Yes.
Caution is the word. All right, that's it for us for today. Happy Monday, everybody. I'm Alix Steele from The Street.
And I'm Scott Redler. Follow us on the virtual trade floor in the chat. Lots of headlines to deal with. And like I said before, 1,000 eyeballs are better than 2. Use them to your advantage.